Hey everyone, it's Andrew and Dave here from FTC. I've had a few clients reach out to me in relation to depreciation, so I thought I'd do a short video so we can maybe work through it and help all of us understand it a bit better. So firstly, what is depreciation? Depreciation is when an asset loses value over time. So when we're talking specifically about an investment property, we're talking about the actual building and the appliances inside, whether it be stoves, kitchens, that type of stuff. But basically, it's stuff that, or it's the assets that lose value. When it comes to properties as well, land, unfortunately, is not depreciable just because land usually appreciates in value. So for the purposes of a depreciation charge or depreciation cost, land is excluded every single time. So say, you go down to Schofields, we're here in the Northwest, and you buy a home and land package for 1.25 million. 450 grand of that is the building, 800 grand of that is the land. So the purposes for depreciation, only the 450K would be depreciable over the term of the asset. The land will be completely excluded. If you try and put land in the depreciation charge, the government will find you and they will definitely come hard after you as well. So when it comes to depreciation, there are two types of charges. You've got diminishing value or the prime cost method. Not charges, I should say, but methods. The prime cost method assumes the value of the depreciating asset is equal over the lifetime. So with property has a effective life of 40 years. So for the purposes of the prime cost calculation, it's 40 years. It's 100% divided by 40 years, which is 2.5% per year. So when we're doing that calculation for the tax return, it's 2.5% per year. The diminishing value method is similar. However, it accelerates depreciation in the first part of the effective life. So the effective life is exactly the same. It's 40 years, but the depreciation charge is rammed into the first few years. It rams the first few years, but overall, between the PC and the DV methods, the depreciation charge is exactly the same at the end of the 40 years using both methods. So as you can see from these two graphs, as you can see, the DV method starts really high and it sort of goes smaller and smaller and smaller until it gets to zero. Whereas the PC method is exactly the same per year, each year, until the effective life is finished. So both methods, when it comes to depreciation perspective, have the same charge overall. So here we have a schedule from an actual depreciation schedule, and we have the two types of methods. You have DV and the PC method. So if we look at 1 of July 2018, that year, you can see that plant and equipment is depreciated by 6,986 plus a capital works depreciation charge of 5,995, giving us 12,918 for the whole year. That's using DV. If we look at the PC method for the same year, we've got for property for plant and equipment, we've got 3,887 plus 5,995, giving us an overall charge of 9,882. So you can see the variance between the two charges. DV is giving a depreciation charge for year 2 for 12,981 versus 9,882. So this is where your tax advisor or tax specialist can come into play. You can choose to elect which type of method you'd like to use in your tax return. However, it also makes sense to use the depreciation when your taxable income is at its highest. So if you foresee your taxable income increasing significantly over the next few years, then it may make more sense to use the PC method, which is the method that's exactly the same each year per year, rather than ramming the depreciation into the first few years using the DV. Because the way that depreciation is calculated, it's the total charge times by your tax rate. So if you've got a $12,981 tax charge, 12,981 depreciation charge, and your tax rate is 32%, then the effective refund is going to be 32% from a tax perspective. If you're on the highest tax rate of 47%, then your tax refund will be 47% of 12,981. So this is where it all comes down to tax planning. There's no point to use this 12,981 if your taxable income is lower. It's better to use that depreciation charge later when your income's higher. David, anything to add?
Yeah. I just don't think there's a right or wrong in terms of which method you do choose for your tax return. Some clients will want to use the diminishing value method because it will really maximize short-term cash flow, which you can use to invest and so on and so forth. Or some will just prefer the prime cost method because it's a more predictable amount year on year. So your refund will be more consistent year on year as well. I just want to add one thing as well, just with depreciation, when you actually sell the asset, any depreciation that you've actually claimed in your previous tax returns must be added back to the calculation. So you effectively kind of have to reverse that deduction in the year that you actually sell it. So that's important to know when you're actually selling the asset. So basically, never sell your asset.
Perfect. No dramas. Well, we'll do more videos like this, and we'll hope to hear from you soon. If you have any questions, feel free to DM us, and we'll try and answer your questions as quick as possible.
Awesome. See ya.